But let's get straight to our next management, the management of Equitas Small Finance Bank. Mr. Vasudevan, the MD and CEO of the company, joins us on the show. Hi, Mr. Vasudevan. Good morning, and always good to see you, Ben. Give us a few details about asset quality in the past quarter. What was the impact of the Tamil Nadu funds on the NPAs, and how much of this can be recovered?
Good morning. So the third quarter, we had a gross slippage of around 4%. That compares to around 3.3% of the second quarter. But however, if you look at the third quarter of previous year, the gross slippage was about 5%. So comparative to the same quarter of last year, 5% has come down to 4%. Typically, the third quarter is a time when most of the southern India, we experience the heaviest rainfall. And traditionally, historically, the third quarter slippages and NPA do tend to follow that trend. And fourth quarter generally, of course, picks up once the rains abate. In terms of our NPA, we also did a securitization transaction in the third quarter, which is the first time that we have done a securitization after becoming a bank 7.5 years back. And the effect of that was that, the denominator, the assets went down because we had securitized. If you adjust for the securitized portfolio, then our GNPA movement is not much. From 2.21% in second quarter, it moved to 2.39% in the third quarter. So if you adjust for the securitization, the NPA hasn't really moved up much. The rainfalls that you mentioned in Tamil Nadu, we had a pretty severe rainfall in the month of December. But most of that is behind us, and most customers have come back to normal now.
Okay, got it. So can you tell us, Mr. Vasudevan, hi, good morning, and hope you're well. Can you tell us what is the outlook as far as growth is concerned? What is the MFI portfolio growth looking like over the next, say, a couple of quarters? And what do you see as the big challenges now for the business?
So in our case, that we are one of the few small finance banks which have a very well diversified portfolio of assets. Microfinance, which is our unsecured portfolio, is about 19%. The remaining 81% are secured loans, comprising of 38%, which is our loans to small businesses secured by house property, 25%, which is secured against vehicles, and about 11%, which is an affordable housing finance. So you see that we have a very broad, spread out of portfolio. Microfinance itself is about 19%, which we have mentioned in the past that consciously we have been reducing that because the microfinance do tend to have a severe impact based on external events. In terms of overall growth, for the 9 months, we have a growth of 32% on the advances. But for the full year, we have been guiding that our growth will be anywhere in the range of 25 to 27, 28%. And on an ongoing basis in the short to medium term, we should be looking at around 25% growth, given the size of the bank, which is quite small actually still at this point in time, and also given the fairly large level of unmet demand in the informal economy segment that we actually service.
Okay, all right. Mr. Vasudevan, also if you could tell us, in terms of the margin outlook, what is your cost of funds and how do you see margins panning out from here on?
So yes, we had the bad impact of the interest rate rising scenario because we are a bank with about 85% of our loans on fixed rate basis. So when the rates have been going up over the last 1 to 1.5 years, our cost of funds has been going up, but we have not had the benefit of the portfolio yield moving up because 85% is fixed loans. And in spite of that, we have been able to maintain a pretty decent returns ratios. Our NIMs, we ended last year at about 9%, and the NIM for the third quarter, December quarter, was about 8.36, and we have guided that we may have an exit NIM in March 24 of around 8.25 to 8.3%. And overall, for the full year, the NIM should be about 8.5 compared to 9 of the previous year. So effectively, you can say that 0.5% is the full year impact of NIM based on our cost of funds moving up and a large amount of loans being on fixed rate basis. And now when we see that the next few quarters, we expect the rates to either remain steady or maybe even start going down, that could be interesting time for a bank like us because we'll have the reverse impact over the next few quarters.
So on the credit cost, how much has the MFI book seen an increase in credit costs? If you could just quantify that for us, and what is the expectation over the next few quarters?
See, MFI, as I mentioned, is about 19% of our book. So, I mean, we don't really need to focus too heavily just on that 19% of the book. But to specifically answer your question on MFI, our credit cost in the MFI is in the range of around 2.5%, compared to the overall credit cost of the bank for the first 9 months at 0.9%. So you can see that yes, microfinance has had a higher level of credit cost compared to the rest of the book. Our pre-COVID credit cost for the bank as a whole used to be about 1.25%. So I think we are pretty much getting back to our normal levels. Our GNP used to be 2.5% pre-COVID. We are about 2.4% now. Our credit cost used to be 1.25. We are at about 0.9 or 1%. So more or less, I think we are getting back to the pre-COVID levels at the bank.
All right. We leave it there, Mr. Vasudevan. It's a pleasure having you with us here on the program, as always. Good luck.
Thank you.
And good speaking with you. All right. We'll, I think, take another... All right. We won't take a break. We'll just sort of update you on the market. It's blinking like a traffic signal. Red and green. Nothing at all. Quite literally. 21,950 is where we are at. So absolutely quiet is what you have. Let's focus on another...